How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is your daily update on Australian dollar versus US dollar. It's been a while since I did a daily update. However, last episode, we talked about dollar continuing and following its seasonal tendency, and foreign exchange currencies like Australian dollar, British pound, New Zealand dollar, and Euro dollar most likely continue to follow its seasonal tendency, being bearish for the month of August. And as we can see, that exactly continued here. After these three up close days, we got a sell-off here. And if you've been following me for a while, you know what I call this: counter trend days in a downtrend. So if price was creating lower swing highs and lower swing lows, if you get an up day within that trend and you figure out that you're going to be bearish, you're going to most likely try to see selling occur after up days. You see these three up days, quick sell-off and continue to break down. This was CPI. You can see there's a buy stop raid here. So price comes up, taps right back into what? The old PD arrays, the 20-day IPTA low, the 40-day IPTA low, and even running that swing high for a buy stop raid, running the buy stops above here. So anybody that was short, as a stop loss above here, that news event there ran right out and then dropped down. We can see as well, we got down to the 60-day low. So we can see how IPTA is still influential going into a new month. Many people asking, why do I do it this way? When I first watched that episode or that lecture by ICT, the way he taught it, I took it directly as he said there and not in any other videos. That very first IPTA lecture that he had that explains coming to the start of the month and looking back 60 days and breaking it down into 20-day increments. I do that every single month and I've been finding success with it. Now, that doesn't mean you have to do it just like that. I'm just bringing to the community how I utilize a method that I learned by someone else and how I find success using it. That doesn't mean you have to do it exactly that way, because there's other ways of utilizing IPTA. The same way there's different market maker models, the same way there's different models from Larry Williams, you can utilize them. You don't have to use every single one, but pick one and learn it and master it like the back of your hand, and then try to use it in your trading. And if you don't find consistency in it, drop it and find a new model. I had to go through trials and tribulations, and I found that this is one that really works for me. We can see price as well. Inversely to this, DXY is going higher. So if you see Australian dollar going down, dollar is most likely going up. So we can see here, we have that IPTA range too. This is our 20-day cast forward here. 20-day look back, 40-day, 60-day. So we have the highs and the lows for those respective quadrants. And we have this PD array that we thought we were going to see that sell off from. But instead of price respecting it and continue to go lower, we can see price gets above it. And now it's probably using it as your classic retail, quote unquote, break resistance turn support. So price is coming up into it, getting through it, using it as support now, and then going higher. Odds are we're probably going to draw for the 20-day high. I would like to see that happen here. We can see that this candle probably or most likely will close bearish. We do have 7 hours left, but odds are the market may not do much now, because it's now, what time is it? It's now 11:33, so we're still in London close. Market may not do much here, but I could see probably price closing down, small range, and then the next trading day going into Wednesday, we might see a large range pushing up to that 20-day high. That's a scenario as well. We do have that fair value gap here that was formed, so price could come down on Wednesday, take out the previous daily low, and then run higher. Not to mention that CPI day here, that large wick that we're all seeing here. We can see that it runs previous daily lows. It looks just inverse to AU when AU went up instead and ran that swing high. DXY looked to like run that swing low, but it never gets there. But it wouldn't be surprising if it had got there, running that swing low and then going back higher. Instead, you can see it runs previous daily lows. This low here, this low here, and this low here. Ideal scenario for buying is after breaking a low. That's what the commercials normally will suggest themselves to do. And that's what I suggest you traders to do as well. If you're going to look for a great buying opportunity, wait for the previous daily low to be rated and then buy the next day, especially if you're in an uptrend. You can also see as well the down days. I always refer to this as well because it's a very simple approach when looking at the price action really quickly. You see this market is trading up. Just look at all the down days. Doesn't take a rocket scientist or a genius to figure this out. After the down days in an uptrend, they're buying. Look at how many down days we have. Down, 2 downs, another down, and we could potentially have another one. odds are we can infer that if we got a down day, maybe tomorrow or even the following day, because it could be 2 consecutive or 3 consecutive down days, then you get a large day back up to take out the gains that were lost, to recover the gains that were lost. That can happen. You can see here, in that instance here, 2 down days, but price gets back up there. 2 down days, but price uses a large candle to recover those gains. So that's something you can use and infer to when trading. You don't have to use very complex approaches to trading. Make it very simple for yourself and digestible. That's what I want to bring to the trading community. Digestible ideologies. Something very straightforward that a child can learn. If I had to teach a stranger on the street, this is how I would teach them how to trade. To look for these certain signs or fingerprints in the market price action. We also see higher swing lows and higher swing highs are unfolding. I also want to mention from this high here to this low here, we used the fib at the beginning of the month. If you go back to the very first daily update for the month, I always do this. I go into more detail. I took a fib from this high to this low. Cut that range in half. We got the fair value of that range or equilibrium. We can also see how price drops below that equilibrium price point and finds buying. There's a buying opportunity there. From this range high, 60-day high, to that 20-day low, the largest range that we're currently in, right? Price is probably trying to get outside and find that liquidity above these highs. So that's how I was most likely able to project or suspect. At first, my idea went from being bearish, as you guys knew earlier. I was like, okay, this is going to be bearish. But then I switched back over to being bullish in the last episode. And ever since then, come back, you can see now price is still going up higher. But look at the buy opportunity. It dropped below the equilibrium price point, that dashed line here. Price drops below it during CPI and it runs back higher. You can also see price during that CPI release here. It also drops below August opening price as well. If I have it marked off right, I think I do. I do not. There we go. That's August opening price here. Oops, very close. Right there. That's the opening price right there. See how price spikes right down. Now, if you're telling me that's random, then I think you might have to check price action out again, because that can't be random. Why does it hit the opening price again and drop below it at one point in time and then run back up really quickly? Because that's where the sponsorship and buying is occurring. They're buying cheap below August's opening price. That's what's happening there. Overall, you could also see that the yields are going up as well. So this is something I mentioned to the channel in the chat. The yields, US yields, have been going up. So if we take a look at something that's correlated to the DXY, so we come to the bond yields here, you can see here on the daily it's going up, but I want to refer to the weekly. This is the 2-year weekly bond yields here, and you can see how price action is bullish. Ever since we had that large sell-off here back in March, we can see a quick recovery of those yields there. Price comes up and doesn't respect, let's say, quote unquote, let's say we're using this last up close candle as our bearish order block. Look how price trades up into it, doesn't respect it. It's getting beyond it. It breaks the high here. And if it breaks this high, odds are it probably might continue breaking highs and moving further. But if you look at the price action, you can see there's higher swing lows forming out here. Price is creating higher swing lows and higher swing highs. So it breaks a swing high, let's say this one, if you had to take a reference here. It breaks this swing high, and after breaking that swing high, where does the next higher swing low come into play? Here. 1, 2, 3. That's your swing low. After this swing low, most likely buying should come into the marketplace. And this is on the weekly chart. The same idea can be seen on the daily. It's just a fractal idea. And price is most likely going to trade higher. We also have another higher swing low here. 1, 2, 3. That's the swing low here. Price is most likely going to continue to trade higher to reach this swing high up here. If we look at the 5-year, the same thing can be seen. Higher swing lows. Of course, there's going to be a point in time where price raids lows. As you can see right here, price raids a low. That's going to happen because in order for it to get sponsorship, we need to take out the sell side. Take out the sell side, run back up to the buy side. Many people may ask, oh, but what about this? Because I know there's going to be people that's going to ask about this. What about this? At one point in time, it looked bearish. Yeah, it looked bearish. But now it has changed trend. How do you find the trend? You look to see if we raid swing a sell side area, and do we, after running that sell side, do we quickly run back to buy side? We do. We go up, raid, right? Got that raid there, and then a revert. Purging. Purge down, revert back, quickly taking out what? A swing high. And you can see the whole system follows again. Swing high rated. What happens after breaking the swing high? You wait for a higher swing low. Where does the higher swing low form? Right here. 1, 2, 3. After breaking this swing high. That's how you're finding your overall bias to the market. 1, 2, 3. Where does it also land in? A PD array. What are the odds? What are the coincidence that the higher swing low, it's forming inside the busy or the fair value gap? Yes, I know this one doesn't run through speed, right? The fair value gap here. Sorry, the swing high here doesn't run through here. The speed doesn't run all the way up through this swing high for the shift, but it's still something to take note in price action. It's a large inefficiency. Price trades down into it, creates another move up higher. Let's take another look. Where's the next higher swing low? Right here. Where's this higher swing low landing? On what? A down closed candle, which is what? Bullish order block theory. So let's say we're just taking the body of the candle. Look at that. Can't be random. It can't be. And it trades higher again and creates what? Another higher swing low. And after that higher swing low, what do we see? A down closed day. What happens after the down day? Buying. And we also have another higher swing low. So the market is what? Bullish. It's showing you that it's bullish. It's showing you that it's bullish. That's the 5-year. The 10-year is the same thing. Doesn't matter. The same thing. Just a quick breakdown here. That's a swing low. That's a higher swing low. That's a higher swing low. That's a higher swing low. Could it not be any more obvious? Look at the PD array here. Trades down into it. Got that higher swing low. Higher swing low. Higher swing low. Look at the down closed candle here. Where's this swing low forming? Inside. Let's take the largest one here that we have. The largest bulky candle here. Look at where it's trading into. The bullish order block. Price is trading higher again. 30-year, the last one we have here. Swing low. Higher swing low. This is a higher swing low, but look at the raid. See? I mentioned this in the most recent video on bullish and bearish months in the characteristics. You're going to have a raid probably on sell side. Get retail traders to think it's probably going to go short and then run it back up. That's going to happen. You're going to see price trade right through a swing low. And that could also be the start of a new trend. But in order for that new trend to unfold, you need to get what? A lower swing high. And then price continues to break lower. But if you don't get that lower swing high after breaking that swing low, then most likely it's just a sell stop raid. They raid the sell side and then run right back up quickly. See how quickly after taking that low out, how quickly they push it back up to get to that swing high up here? Can't be a coincidence. Think about the nature and how fast they're moving the price action after raiding a significant price point like a swing low. Run a swing low, but you want to run quickly back up to a swing high, you must be going higher still then. That's how you got to think about it. Think like the market makers. Think as if you were controlling the price action and controlling the masses to believe that price is going to go in an intended direction. How can I get everybody to think price action is going to go lower? Let's just run this low. Run the low and get them to all go short. When I'm on the flip side, or actually I'm buying the whole time in these down days. These down weeks, 1, 2, 3, 4 down weeks, and they're getting smaller and smaller. Just the bodies. Don't worry about the wicks. The bodies are getting smaller and smaller and smaller until finally price goes right back up. Large. Look how large this one weekly candle is compared to the last 5. 1, 2, 3, 4. Yeah, 5 candles here. Even 6. Look how large it is. So we go from a large range, like how large this candle is, that large push up. Then we start going what? Tiny again. Oops, I should have encapsulated the other one too. Tiny bodies again. Until what? Another large week. There you go. Notice as well. Look at all the down weeks. What's happening after these down weeks? Buying. Look at these down weeks here. Quickly getting away from the down weeks. So hopefully this was insightful. Like I said, the concepts that I teach are very simplistic. They don't change. They don't change. All in all, still bearish for foreign currency. We did raid that 60-day look back low for AU just to bring it back home. We did raid that there. You can even see on the weekly chart, we failed to break that high here. So we just take off the annotations real quick. Look how we failed to break that high, but instead we break down. And what did we do? We break a swing low here, and we break another swing low. What is most likely going to happen in the near future for AU? Potentially a lower swing high formation inside some type of PD array. Let's say these two last down close candles, right? Price trades up, or even the fair value gap here that it didn't respect for the bullish setup, right down, up here, right there. Instead of that happening, we can see price coming down, up, back into that fair value gap here as what? Your classic retail turn, break, support, turn resistance, and then go shorter, creating what? The lower swing high. So hopefully this is insightful. Peace.